All right, I need you to lock in for the next few minutes. What I'm about to walk you through is not a theory. It is not a rumor circulating on financial forums, and it is not the kind of story that gets covered on CNBC between car commercials and pharmaceutical ads. This is about something that happened quietly, without a press release, without a congressional hearing, and without a single primetime anchor mentioning it by name. On the morning of March 17, 2025, a regional bank in the United States processed fewer than 40% of its scheduled outbound wire transfers during a routine business window, not because of a cyber attack, not because of a technical glitch, because the liquidity available to clear those transfers had fallen below the internal threshold required to execute them. The bank did not announce this. It did not send letters to customers. It quietly delayed, rerouted, and in some cases silently held those transfers in a processing queue for up to 72 hours. The customers whose payroll runs, vendor payments, and real estate closings were sitting in that queue had no idea. They just kept refreshing their screens, wondering why the money hadn't moved. That is not a crash. That is not panic. That is not a rumor. That is a system reacting to internal stress in the only way it knows how: quietly. And when systems start reacting quietly, it means the pressure has already been building long enough that the visible release valves are no longer sufficient. I have watched this sequence before. The names change, the institutions change, the specific trigger changes, but the mechanics do not. And what I am watching right now across the wire transfer infrastructure of the American banking system tells me that something has already started. The question is not whether you will feel it. The question is whether you will understand what is happening before your access becomes conditional. Let me be precise about what a wire transfer blackout actually means in structural terms, because the phrase sounds dramatic, but the reality is far more clinical and far more dangerous than the drama suggests. The Fedwire fund service, operated by the Federal Reserve, processes on average over $4 trillion in transactions every single business day. $4 trillion. That is not annual volume. That is daily. When that system operates normally, it is invisible. Money moves, counterparties settle, payrolls clear, real estate closes, businesses function. But Fedwire is not the only layer in this system. Between the Federal Reserve's settlement infrastructure and your actual bank account sit multiple layers of correspondent banking relationships, intraday credit facilities, and liquidity buffers that individual institutions maintain to fund their settlement obligations throughout the day. These buffers are not infinite. They are calibrated to expected transaction volumes using historical averages and stress assumptions. And when the stress assumptions stop matching reality, the buffers run short. What happens next is not an announcement. It is a queue. Transfers get held. Priority gets assigned internally, usually by size and counterparty relationship. Smaller transfers from retail customers sit longest. And the customer, the business owner waiting for a payment to clear, the family waiting for a wire to settle on a home purchase, they are told nothing except that processing times may be delayed. This mechanism has a name inside the Federal Reserve's operational literature. It is called intraday liquidity stress, and the Fed has been publishing increasingly specific guidance about it since 2023. Not because everything is fine, because institutions have been testing the outer limits of their intraday buffers with enough frequency that the regulator felt compelled to formalize the warning framework. The February 2024 update to the Federal Reserve's payment system risk policy specifically tightened the collateral requirements for institutions accessing daylight overdraft credit through Fedwire. Daylight overdrafts are the mechanism by which banks borrow intraday from the Fed to fund transfers before incoming funds arrive. When the Fed tightens those collateral requirements, it means some institutions can access less intraday credit than they previously could. And when institutions can access less intraday credit, some of their transfers do not clear on time. This is not theoretical. This is the operating reality of the payment system right now. I have been watching versions of this sequence play out for decades. I watched it in the early stages of the savings and loan crisis in the late 1980s when institutions were quietly managing their settlement obligations through informal interbank arrangements that looked normal from the outside until they stopped working. I watched it in the weeks before Bear Stearns collapsed in March 2008 when counterparties were quietly reducing their repo exposure to the firm while publicly saying nothing had changed. I watched it in September 2019 when the overnight repo rate spiked to 10% in a single session, a move that had no single identifiable cause but reflected a systemic liquidity shortage that the Federal Reserve had to address with emergency overnight operations for weeks. In none of those cases did the wire transfer window freeze completely on day one. In all of those cases, the early signal was quiet operational stress that most observers dismissed as technical noise. It was not technical noise. It was pressure. Now let me walk you through the specific mechanism that makes a wire transfer blackout not just possible, but structurally predictable, given what is happening in the banking system right now. And I want to be precise about this because precision is what separates genuine systemic analysis from clickbait. There are 3 interlocking pressure systems converging simultaneously, and each one individually would be manageable. Together, they are not. The first pressure system is the commercial real estate maturity wall. According to the Mortgage Bankers Association, approximately $1.8 trillion in commercial real estate loans are scheduled to mature between 2025 and 2027. These are not new loans being originated into a functioning market. These are loans that were written when office buildings commanded full occupancy rents, when interest rates were between 2 and 4%, and when the assumption of refinancing at similar or better terms was considered conservative underwriting. That assumption is now mathematically broken. Current commercial real estate lending rates sit between 6.5 and 8.5%, depending on asset class and borrower profile. Office vacancy rates in major metropolitan markets are running between 18 and 24% nationally, with cities like San Francisco, Chicago, and Dallas showing distress rates that exceed anything recorded outside of the 2008 to 2010 period. When a loan matures on a building that has lost 30 to 40% of its value and cannot be refinanced at rates that allow positive cash flow, the borrower has one rational option: default. And that default lands directly on the balance sheet of the lending institution as a non-performing asset that must eventually be marked to market and absorbed as a loss. Regional and community banks hold approximately 68% of all outstanding commercial real estate loan exposure in the United States. This is not a secret. It is disclosed in Federal Reserve flow of funds data. These are institutions with total asset bases between $1 billion and $100 billion. They are not JP Morgan. They do not have the derivative hedging infrastructure, the deposit diversification, or the Federal Reserve backstop relationships that the systemically important banks have. When their commercial real estate portfolios begin taking concentrated losses, the impact on their capital ratios is immediate and severe. And when capital ratios deteriorate, the first thing that changes is their access to intraday credit facilities. Which brings us back to the wire transfer window. The second pressure system is the deposit base erosion that has been occurring steadily since the Federal Reserve began its rate hiking cycle in March 2022. Between the first quarter of 2022 and the end of 2024, total deposits at U.S. commercial banks declined by approximately $1.1 trillion. This was the largest sustained deposit outflow in the post-World War II era. Some of that money moved into money market funds chasing higher yields. Some moved into treasury bills directly. Some moved into larger institutions perceived as safer. The net effect is that the funding base that regional banks use to support their loan portfolios, including their commercial real estate exposure, has contracted materially at precisely the moment when loan losses are beginning to materialize. This is a classic liability asset mismatch. The funding is leaving while the problem assets remain, and the institutions caught in this squeeze have limited options. They can raise deposit rates to attract funding back, which compresses their net interest margins and reduces profitability. They can sell assets to raise liquidity, which forces them to realize losses they have been carrying at book value. Or they can reduce their settlement activity, which means holding wire transfers in queue rather than clearing them in real time. The third pressure system is the least visible and arguably the most dangerous. It is the Federal Home Loan Bank system and its role as the emergency funding backstop for stressed institutions. The Federal Home Loan Banks are a network of 11 regional government-sponsored enterprises that provide secured lending to member institutions. When a bank loses deposit funding, it can borrow from its regional Federal Home Loan Bank by pledging collateral. This mechanism is supposed to be a temporary liquidity facility for sound institutions facing short-term funding gaps. In practice, in the current environment, it has become the primary funding source for a growing number of institutions that are not experiencing temporary funding gaps. They are experiencing structural funding deficits driven by the exact combination of commercial real estate losses and deposit outflows I just described. Federal Home Loan Bank advance outstanding balances hit a record $1.04 trillion in late 2023, surpassing even the peak levels reached during the 2008 financial crisis. The Federal Housing Finance Agency, which regulates the federal home loan banks, published a report in November 2023 explicitly warning that the system was being used as a funding backstop by institutions that were under supervisory stress, a function it was never designed to perform. When the emergency backstop of the emergency backstop is under strain, the redundancy that the system relies on to prevent cascading failures is no longer intact. Now let me show you exactly what the historical record tells us about what happens when these three pressure systems converge, because this is not a scenario I am constructing from imagination. This is a pattern that is repeated with enough consistency across enough different economic cycles that calling it coincidence requires deliberate ignorance of the data. In 1984, Continental Illinois National Bank, at the time the seventh largest bank in the United States, experienced a wire transfer disruption that preceded its collapse by approximately 6 weeks. The sequence was specific. Institutional depositors, primarily other banks and large corporations with balances well above insurance limits, began quietly reducing their wire transfer volumes to Continental Illinois. Not because they announced a concern, because their internal credit risk systems flagged the institution as elevated risk and they reduced their settlement exposure accordingly. Continental Illinois saw its intraday funding requirements become increasingly difficult to meet as counterparties pulled back. The bank began delaying lower priority transfers. By May 1984, the Federal Deposit Insurance Corporation had to intervene with an $8 billion rescue package, the largest bank bailout in American history at that point. The wire transfer stress preceded the public crisis by weeks. The public had no idea until the rescue was announced. In 2008, Washington Mutual, the largest savings and loan institution in United States history with over $307 billion in assets, experienced an accelerating deposit outflow in the weeks before its seizure by the FDIC in September of that year. What is less well known is that in the final 2 weeks before the seizure, WAMU's wire transfer processing times began extending materially. Institutional clients were reporting delays. The bank was struggling to maintain its intraday liquidity position as the deposit outflow accelerated and its access to wholesale funding markets contracted. The FDIC seized WAMU on September 25, 2008, in the largest bank failure in American history. Again, the wire transfer stress was a leading indicator. It appeared before the headlines. It was visible to those watching the operational data. It was invisible to depositors who had no mechanism to access that information. In March 2023, Silicon Valley Bank collapsed over the course of approximately 48 hours following a disclosure that it had taken a $1.8 billion loss on its bond portfolio. What is important for our purposes is not the headline. It is what happened to SVB's payment processing in the 24 hours before the FDIC takeover. According to Federal Reserve operational data released in the post-mortem review, SVB's Fedwire settlement account went into overdraft multiple times during the final business day before its closure. The bank could not fund its outbound settlement obligations from available liquidity. Transfers were queued, some did not clear. The operational stress on the payment system was the mechanical expression of the underlying solvency problem, and it appeared before the doors closed. The pattern is not ambiguous. Wire transfer stress is not a consequence of bank failure. It is a precursor. It is the point in the sequence where the internal liquidity pressure becomes severe enough that it begins expressing itself in operational behavior. And the reason it matters more today than it did in any of those previous cases is because the interconnection between institutions has deepened materially since 2008. In 2008, a failure at one institution created contagion through counterparty credit exposure and funding market disruption. In 2025, those channels still exist. But there are additional transmission mechanisms that did not exist in the same form in 2008. Specifically, the concentration of commercial real estate exposure across hundreds of mid-size regional banks simultaneously means that the stress is not localized to one institution. It is distributed across a cohort of institutions that are all facing the same pressure at the same time. When multiple institutions are simultaneously managing intraday liquidity stress, the interbank payment system itself becomes congested. Transfers that would normally clear in minutes begin queuing. Processing windows that were designed to operate with redundant capacity begin running at or near limit. And the feedback loop between one institution's delayed incoming transfers and another institution's inability to fund its outbound transfers can compress very quickly into something that looks, from the outside, like a system-wide slowdown. This is the mechanism that regulators are not explaining clearly to the public. It is not about one bank failing. It is about a sufficient number of banks simultaneously managing the same stress to the point where the settlement infrastructure itself begins to reflect that stress in its operational throughput. The Federal Reserve's own financial stability reports have been escalating their language around this specific risk for the past 6 quarters. The April 2024 Financial Stability Report specifically cited funding vulnerabilities at institutions with concentrated commercial real estate exposure as an elevated concern. That is not reassuring language from a regulator that defaults to reassuring language. Now, I want to address something directly because it is the question that matters most practically. If you cannot move your money when you need to, what does that actually mean for your financial life? And what does the legal framework say about your rights in that scenario? The answer to that question is more uncomfortable than most people expect. Under current Federal Reserve payment system risk policy, there is no legal requirement for a bank to process your wire transfer within any specific time window. None. The bank's obligation is to process the transfer within a reasonable time, a standard that is defined by the institution's own operational policies and the broader customs of the banking industry. In practice, this means that if your bank is experiencing intraday liquidity stress and holds your wire transfer in queue for 24, 48, or 72 hours, they are operating within their legal rights. You have no recourse. You cannot compel the transfer. You cannot access a parallel mechanism. You can complain to the Consumer Financial Protection Bureau, which will acknowledge your complaint and do nothing in a time frame that is operationally meaningful to you. This is by design. The legal architecture of the payment system prioritizes systemic stability over individual access. When the regulators wrote the rules governing wire transfer timing, their explicit concern was preventing a liquidity cascade that could bring down the system. Your time-sensitive transfer was not their primary concern, which means that in a stress scenario, the institution's right to manage its liquidity position takes precedence over your expectation of immediate access. This is not a conspiracy. It is disclosed in the terms and conditions you agreed to when you opened your account. It is just written in language that no one reads until the moment they need to understand it. There is a related mechanism that makes this even more structurally significant. Under the Dodd-Frank Act and the resolution planning requirements implemented through Title I and Title II, systemically important financial institutions are required to maintain resolution plans, so-called living wills, that specify exactly how the institution would be wound down in an orderly manner if it became non-viable. One of the key provisions of those resolution plans involves the treatment of payment and settlement activity during a resolution weekend. Under the FDIC's orderly liquidation authority, when a systemically important institution is placed into resolution, the FDIC has the authority to impose a temporary stay on the termination and transfer of financial contracts. This stay can encompass payment obligations, which means that in a formal resolution scenario, outbound transfers from the institution in resolution can be held pending the resolution process. For institutions that are not systemically important, the FDIC's standard receivership process does not include the same stay mechanism, but it does involve a transfer of operations to a bridge institution, a process that historically takes between 48 and 96 hours, during which payment processing is interrupted. In plain language, if your bank enters FDIC receivership on a Friday evening, which is when the FDIC historically executes bank takeovers, your access to your funds through wire transfer will be interrupted for a minimum of 1 business day, and potentially for multiple days depending on the complexity of the resolution. If you have a transaction that needs to close during that window, it does not close. If you have payroll that needs to run during that window, it does not run. If you have a contract obligation that requires funded settlement during that window, you are in default, regardless of the fact that the funds exist in your account. The money is there. You simply cannot move it. And that distinction between money that exists and money that can be accessed is the precise definition of a conditional bank balance. Let me now tell you what the current data shows about the institutions that are most exposed to this risk, because I will not give you a warning without giving you the specificity that makes it actionable. The Federal Reserve's most recent stress test results, published in June 2024, showed that the 6 largest U.S. banks would lose a combined $685 billion under a severe adverse scenario, but would remain above minimum capital requirements. That is the good news about the large institutions. The stress test results for smaller institutions tell a different story. The FDIC's quarterly banking profile for the third quarter of 2024 showed that the number of banks on the FDIC's problem bank list had risen to 68, the highest level since 2016. More significantly, the aggregate unrealized losses on investment securities held by FDIC-insured institutions stood at $364 billion as of the same period. These are losses that exist on balance sheets right now. They are not hypothetical stress test losses. They are actual losses embedded in actual portfolios that have simply not yet been realized because the institutions have not been forced to sell the underlying securities. When combined with the commercial real estate loss exposure I described earlier, the total embedded stress on the regional banking sector is operating at a level that the system has not had to manage since the period immediately following the 2008 financial crisis. The specific geography of this risk matters too. The markets with the highest commercial real estate distress rates, Dallas at 19%, Chicago at 17%, San Francisco at 22%, are also the markets where the highest concentrations of regional bank commercial real estate exposure are located. These are not randomly distributed risks. They are geographically clustered in specific markets where specific institutions have specific concentrations. And when those losses begin materializing in a synchronized way across a geographic cluster, the regional banks serving those markets face simultaneous pressure on capital ratios, deposit funding, and intraday liquidity access. Now I want to tell you what happens next. Not as a prediction with a specific date, but as a sequence of events that follows mechanically from the current state of the system. The maturity wall for commercial real estate loans continues to build through 2025 and 2026. As each quarter passes, more loans hit their maturity date into a refinancing environment that cannot support them. Defaults accumulate on regional bank balance sheets faster than the extend and pretend strategy can absorb them. At some point, and the timing of this point is uncertain, but the directionality is not, the accumulation of non-performing assets on specific institutions' balance sheets becomes severe enough that their capital ratios approach regulatory minimums. When capital ratios approach minimums, regulators impose restrictions on dividend payments, share buybacks, and in some cases, specific operational activities. Those operational restrictions can include requirements to reduce certain categories of balance sheet exposure, which translates in practice to reducing lending and in extreme cases restricting certain payment activities to preserve capital. Simultaneously, as stress becomes visible at a handful of institutions, the institutional depositors who monitor bank health through credit default swap spreads, stock price movements, and regulatory disclosure will begin quietly reducing their unsecured exposure to the most stressed institutions. This is not illegal, it is rational risk management. But the effect is to accelerate the deposit outflow that is already putting pressure on funding. Faster deposit outflow means faster deterioration in intraday liquidity position. Faster deterioration in intraday liquidity position means more frequent and more extended wire transfer delays. More frequent wire transfer delays become visible to retail customers who begin asking questions, and the dynamic that has been operating quietly in the background becomes visible to a broader audience at precisely the moment when the options for responding to it have narrowed. This is the sequence I have watched before. The timeline compresses faster than most people expect because the feedback loops are tight. What takes months to develop can take days to express once the visibility threshold is crossed. So what do you do with this information? And I want to be direct about this because information without action is just anxiety with extra steps. The first thing you need to understand is your actual exposure. If you have deposits at regional or community banks above the FDIC insurance limit of $250,000 per depositor per institution per ownership category, those uninsured deposits are not protected in a receivership scenario. They become claims in a bankruptcy proceeding that may recover between 50 and 100 cents on the dollar over a timeline of months to years, not days. If you are a business owner with operating accounts at a single institution that regularly carry balances above $250,000, you are carrying uninsured deposit risk that you may not have explicitly chosen to accept. The structural solution to this is not complicated. It is the intraday network, formerly known as CDARS, which allows you to spread deposits across multiple FDIC-insured institutions through a single banking relationship while maintaining insurance coverage on the full balance. It is the explicit diversification of operating accounts across multiple institutions so that no single point of failure can disrupt your entire payment infrastructure. It is the reduction of average account balances below insurance limits through more active cash management, including the use of treasury bills, money market funds backed by government securities, and other instruments that are not subject to bank receivership risk. The second thing you need to understand is the difference between assets that exist inside the banking system and assets that exist outside it. Your bank deposit is a liability of the bank. It is a claim on an institution that may, under specific and legally defined circumstances, have the right to delay, restrict, or in a bail-in scenario, convert your claim. Physical assets, whether they are gold, silver, real property, or other tangible stores of value, do not carry counterparty risk in the same form. They exist independently of the banking system's operational continuity. When wire transfers stop clearing, gold does not stop existing. When a bank enters receivership, the silver you hold in allocated storage does not become a claim in a bankruptcy proceeding. This is not an emotional argument for hard assets. It is a structural one. The specific risk I have described in this video, the risk that your access to your own money becomes contingent on the operational health of your banking institution, is a risk that applies to monetary assets held inside the banking system. It does not apply in the same way to assets held outside it. Central banks understand this distinction perfectly. In 2024, global central banks purchased over 1,000 tons of gold for the second consecutive year, according to the World Gold Council. The buyers included the People's Bank of China, the Reserve Bank of India, the National Bank of Poland, and the central banks of multiple Gulf Cooperation Council states. These are not retail investors making emotional decisions based on YouTube videos. These are institutional actors with access to the full range of information about the global financial system, and they are making a deliberate, large-scale rotation out of financial claims and into physical metal. The reason they are doing this is not mysterious. They are doing it because they understand, better than any retail investor can, the structural vulnerabilities of a financial system built on interconnected claims, fractional reserve banking, and intraday liquidity that function smoothly only when every institution in the network is solvent and well-funded. The question I want you to sit with after you finish this video is this. The wire transfer window that held transactions in queue in March of 2025 did not make national news. The Federal Home Loan Bank advance balances at record highs did not make national news. The $364 billion in unrealized losses sitting on bank balance sheets did not make national news. None of these things were hidden. They were all disclosed in regulatory filings and Federal Reserve publications that are publicly available. They just were not explained in language that made their significance clear to the people whose financial lives depend on the banking system functioning correctly. The system is not broken yet, but the system is bending. And when systems bend, the people who understood the mechanics before the bend became visible are the ones who had time to make decisions from a position of optionality rather than from a position of urgency. Optionality closes fast in a financial stress scenario. The people who wired money out of Silicon Valley Bank on March 8th and 9th of 2023 had options. The people who tried to wire money out on March 10th, the day the FDIC announced the takeover, did not. The difference between those two groups was not intelligence, it was timing. And timing in these situations is almost entirely a function of how early you understood what was happening. I am not telling you the system collapses tomorrow. I am telling you that the mechanics are in place for a wire transfer disruption that, when it happens, will not be preceded by an announcement. It will be preceded by the exact kind of quiet operational stress that I have described in detail in this video. The question is not whether you believe me. The question is whether you are willing to look at the data yourself, read the Federal Reserve's payment system risk policy, read the FDIC's quarterly banking profile, look at the Federal Home Loan Bank advance balances, and form your own conclusion about what the system is telling you. If the conclusion you reach is that everything is fine, that is your prerogative, but reach that conclusion from evidence, not assumption. Because in my experience watching financial systems under pressure, the assumption that everything is fine has never once been a substitute for actually checking. Drop your answer in the comments. I want to know where you are right now. Are you holding uninsured deposits at a regional bank? Do you have a plan for your operating accounts if wire transfers are delayed for 72 hours? Have you looked at your exposure honestly? Or are you relying on the same assumption that the depositors of Washington Mutual and Silicon Valley Bank were relying on? Tell me what you are thinking, because the conversation this community generates around these questions is more valuable than anything I can produce alone. If this breakdown gave you something that the mainstream financial press is not giving you, share it with someone who needs to hear it. Not because of a metric, because the people who understand this will have options that the people who do not understand it will not have. I will see you in the next one.